intraday futures market outlook for September 6, 2011. This is Patrick Ceresna. For those of you that have not had the opportunity to try out eMiniSource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. Does a very good job to depict the bull and bear market cycles that we've gone through. We've now just over the last 3-4 weeks crossed bearishly below that 80-week moving average, begging the question as to whether or not we are seeing the beginning of a new bear market. Whether this will all hinge very much on whether this falls into a full outright recession, or whether or not this is going to be simply just an economic slowdown. One way or another, there's definitely vulnerability of this market to a minimum retest down into the 1,000 level and spend many months below this period before we have a legitimate shot at another bullish push in the marketplace. Just to review our key market observations, the last 6 weeks have dynamically changed the landscape of the market. With us closing below that 80-week moving average, it is certainly given us a technical signal to indicate the beginning of a prolonged bear market. But really what I'm watching is what's going to happen in the U.S. dollar. The U.S. dollar is, and when you'll see a chart shortly, is in a position to potentially break out. And it's being corresponding with a Japanese yen that's rolling over, an Australian dollar that's rolling over, a Canadian dollar that's rolling over, and a euro that could potentially give out on its support. If all of those currencies simultaneously gave a drop, we would see almost immediately a very big, strong, robust push in the U.S. dollars. If the U.S. dollar did make that push, that would send a shockwave through the commodity markets, and we could see big drops in oil, big drops in copper, and we could subsequently see even a high put in gold. So this is going to be a very critical thing. The U.S. dollar still has not made that move, but if it does, it would certainly change the landscape very quickly. And the last point is that the 30-year Treasury bond continues to rally higher, indicating a flattening of the yield curve. And as that Treasury bond continues to rally on the 10-year and the 30 years, it continues to indicate the chances that this economy is going into recession. So always we start off on the daily charts by looking back on that S&P futures chart. You can see that right now when we're doing this recording, it's trading down around the 1140 area on the downside of that S&P. Last week we drew on this wedge. We basically said the market is going to create a rising wedge that's going to push up into these zones, and somewhere in this area between the 1210 to 1250 area, we would see a significant high come in and a subsequent market that corrects. And just like clockwork, if anyone wants to see the value that you get out of your eMiniSource and Option Source memberships, is this all oriented around the fact that the market has done everything like clockwork. At this stage, the only question is, are we simply going for a retest of the lows, or is this the beginning of a new a full leg lower? If it's a double bottom retest around that 1080 to 1100 area, maybe as high as 1110, we could find some short-term support. But if this is an outright full measured move lower, we are going to see the print down in the 1000 to 1020 area at some point in September. I don't know for certain which one this is, but I'll tell you, if a U.S. dollar breakout occurs and commodities sell aggressively, the S&P 500 could very easily find the 1,000 level just based on the commodity sell-off. So when we take a look at that U.S. dollar that I keep continuously referring to, and the risks here, is that the U.S. dollar's been sideways channeled for a better part of 4 or 5 months, retesting those lows that have all been banged out at the 73, 73.50 area. You can see that nice big push higher to 75.50 right up here. We're almost trading at 76 as we speak. If we in any way see that U.S. dollar break above all these highs that occurred in that March, June, and July months, we could see a massive U.S. dollar short squeeze on the upside that could find 79, 80, 81, 82 in a very rapid fashion out until October. If that was to occur, that would be the very catalyst that would create shockwaves not only in the stock market but primarily in the commodity markets. When we take a look at copper futures, we were looking for a retracement to go as high as the 420, 430 area on the top end of a retracement, but we were saying that that's a rising wedge, very similar to what we were saying on the S&P, and that eventually it would all roll over. If this is a rollover here, if that US dollar in any way rallies, that wedge will form, and copper will have a move all the way down to even 350, 370 on the downside. There's plenty of room for copper to have a very significant move over the next month or two. So put on your seatbelt and get ready for a ride if that US dollar breaks out. Next year, when we take a look at gold futures, this is going to be a very interesting scenario because gold has been sort of the bastion of safety, and everyone's been flooding to gold. But just like the Swiss franc was being used as a place of safety, eventually, when a correction begins, it tends to be very dramatic. If we see in any way a significant US dollar rally, it would mean that people are flocking to the US dollar for that safety. If we saw a scenario like that, where the US dollar is being used as a safe haven, that dramatic US dollar rally would cause a significant commodity weakness, and it would probably put a dent into gold, which would put in a double tops or even just almost the head of a head and shoulders formation up along these zones below 2000, and subsequently would end up seeing some sort of a significant reversal and a correction easily back down towards 1700, and maybe if it's significant enough back down to 1600. Next year, when we take a look at crude oil, just like copper, just like the S&P, we have this rising wedge formation that failed at the 90-92 mark like we were anticipating in that blue box. Really, at this stage, oil is going to follow suit. And you can see how this is all interconnected, because if this is all predicated on the US dollar rally. If we have any significant US dollar rally and a significant euro breakdown and all of these currencies roll, we are going to see that S&P, the copper, crude oil, all of these charts follow the exact same pattern, and we will see oil potentially trade even down to 65.70 over this month. Again, a lot of this is going to hinge. Understand that if the US dollar does not break out, then all of these could end up just being retests of the 70. Let's say oil would just retest 70, 80 and then bounce back up. So I don't want to say with any certainty that we have a crash environment set up for the market. But if the US dollar did squeeze on the upside and we had a very dramatic US dollar rally, then it would certainly set the commodity markets and the S&P up for a very dramatic move lower. Finally, I want to look at those 30-year Treasury bonds, and it's now testing that 140, 142 area. We continue to see that if this economy, global economy, goes into a recessionary mode, that there will be a flattening of the yield curve, which will force those 10-year and 30-year Treasury bonds to continue to rally to historic highs. The 10-year is already under 2%. The 30-year continues to drop lower and lower. And as absurd as it seems to me for the Treasury bonds to make it up to the 148 to 152 level at this stage, if we see a massive US dollar rally and subsequently drops in commodity prices and everything happen, we could see a huge massive spike in Treasury bonds that still even takes up 8-9 handles higher. At some stage that would be a mother of all shorting opportunities, but really at this stage you don't want to stand in its way if it wants to go there. That was your Monday Futures Market Outlook. Thank you for joining me.